Most people believe banks only lend the money that savers deposit, but that's not how the system really works. When you take a loan, banks don't hand you existing cash. Instead, they create new money digitally with a few entries on a screen. This process quietly expands the money supply and affects inflation, debt, and the economy as a whole. Today, we'll explain, step by step, how banks create money out of nothing in the simplest way possible. Today, we'll talk about how banks create money out of nothing. Simple explanation. So before we start, make sure to hit the like button and subscribe to my channel. 1. How banks create money out of nothing. Banks do not work the way most people imagine. Many believe banks only lend out the money that people deposit, but in reality, banks create new money when they issue loans. This process is legal, normal, and central to the modern financial system. When a bank approves a loan, it does not hand over existing money from its vault. Instead, it simply creates a digital entry in the borrower's account. This newly created balance did not exist before the loan agreement. The moment the loan is approved, new money enters the economy. This is why people say banks create money out of nothing. The bank records the loan as an asset and the customer's deposit as a liability. No physical cash moves, yet purchasing power is created instantly. This system allows economies to grow quickly, but it also carries risks. If too much money is created too fast, inflation can rise. Understanding this mechanism is crucial because bank-created money makes up the majority of money we use every day, far more than physical cash printed by governments. 2. The role of central banks is commercial banks. Many people think only central banks print money, but commercial banks create most of it. Central banks, like the Federal Reserve or State Bank, create base money such as cash and reserves. Commercial banks then multiply this money through lending. Central banks control interest rates and set rules, but they do not decide how much money is created day to day. That decision happens when banks give loans to households and businesses. When interest rates are low, borrowing becomes attractive and money creation increases. When rates are high, borrowing slows down. Central banks influence this behavior indirectly. Commercial banks respond to profit opportunities, risk assessments, and customer demand. This means money supply is driven by economic activity, not just government decisions. The partnership between central banks and commercial banks forms the backbone of the modern monetary system. Without commercial banks creating money through loans, economic growth would slow dramatically, affecting jobs, businesses, and consumer spending. 3. Fractional reserve banking explained simply. Fractional reserve banking is often misunderstood. It does not mean banks lend out a fixed fraction of deposits mechanically. Instead, it means banks are required to hold only a small portion of deposits as reserves. For example, if the reserve requirement is 10%, a bank only needs to keep 10 out of every 100 in reserve. The rest can be used for lending. However, modern banking works even more flexibly. Banks lend first and find reserves later if needed. As long as banks meet regulatory requirements and can access central bank reserves, they can continue lending. This creates a chain reaction. One loan becomes a deposit, which becomes another loan, and so on. This process expands the money supply far beyond the original deposit. While this system boosts economic activity, it also means banks must manage risk carefully to avoid bank runs and financial instability. 4. Why loans create deposits automatically. When a bank approves a loan, it automatically creates a deposit in the borrower's account. This is a key concept most people never learn. The bank does not check whether someone else's savings are available first. Instead, the act of lending itself creates money. This deposit can be spent immediately, transferring money to other banks and accounts. The banking system then settles these transactions using reserves. This is why lending is the primary driver of money creation. Mortgages, business loans, car loans, and credit cards all contribute to expanding the money supply. Repaying loans destroys money in the opposite way. 5. Interest, the hidden engine of bank profits. Interest is how banks make money from money they create. Since the principal amount is created digitally, the interest represents real profit. Borrowers must earn this interest from the existing economy, which encourages economic activity. However, interest also means total debt always exceeds total money in circulation, creating pressure for continuous growth. This is why economies are growth-dependent. If growth slows, debt repayment becomes harder, leading to defaults and crises. Banks price interest based on risk, inflation, and central bank rates. Higher interest rates slow borrowing and money creation. 6. Is this system good or bad? Bank money creation has advantages and disadvantages. On the positive side, it allows rapid economic growth, innovation, and investment. Businesses can expand, people can buy homes, and governments can fund projects. On the negative side, excessive money creation can lead to inflation, asset bubbles, and financial crisis. The 2008 financial crisis is a clear example of what happens when lending grows too fast without proper risk control. The system itself is not evil, but it requires strong regulation and transparency. Understanding how banks create money empowers people to make better financial decisions and avoid misinformation. 7. Why inflation is linked to money creation. Inflation happens when too much money chases too few goods. When banks create large amounts of money through loans, spending increases. If production cannot keep up, prices rise. This is why central banks monitor inflation closely. They raise interest rates to slow lending and reduce money creation. Inflation is not caused by banks alone, but bank lending plays a major role. Moderate inflation is considered healthy, but high inflation corrodes purchasing power. Understanding this link helps explain why everyday prices rise even when wages do not keep pace. 8. Bank runs and financial stability. Because banks do not keep all deposits in cash, they are vulnerable to bank runs. If too many people demand cash at once, banks cannot meet withdrawals. This is why deposit insurance and central bank support exist. Governments guarantee deposits to maintain trust. Central banks act as lenders of last resort, providing emergency reserves. Without these safeguards, the money creation system would collapse. Trust is the invisible foundation of banking. As long as people believe banks are stable, the system continues to function smoothly. 9. Digital money and the future of banking. Today, most money is digital. Cash makes up a tiny percentage of total money supply. With the rise of digital banking, cryptocurrencies, and central bank digital currencies, money creation may evolve further. However, the core principle remains the same. Money is created through accounting entries backed by trust and regulation. Future systems may increase transparency, but banks will likely remain central players. Understanding today's system prepares us for tomorrow's financial changes. 10. Why this knowledge matters to you. Knowing how banks create money changes how you see debt, savings, and inflation. Loans are not just personal obligations, they're part of a larger economic system. This knowledge helps you question myths and make informed decisions. Whether you are saving, investing, or borrowing, understanding money creation gives you power. Financial education is the first step toward financial freedom. Once you see how money really works, you stop blaming yourself and start understanding the system. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.